Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really glad to have with me once again Michael J. Oliver. Michael now makes available his service to, well, I would guess mostly accredited investors. It's not an inexpensive service, but it's a reasonably priced service for people who are active in the markets and have a fair amount of money to invest. Hedge funds and wealthy individuals primarily, I suppose. But it's I think very reasonably priced for people. So the best place to go is olivermsa.com. Oliver, M as in Mary, S as in Sam, A as in Albert.com for more information. Now, I'm not going to spend time reading Michael's bio because it is posted. He's been with us before. It is posted at the Voice America, at my page on the Voice America Business Channel, so you can go there to catch up more on Michael. He certainly has had a rich background in technical analysis and with some household name companies in the past and that he's done work for. So welcome, Michael. I'm really good to have you with me again today.
Glad to be back, Jay.
Really good. Now, I would like to focus a little bit on your missive on February 8th, this past Sunday. You headed it up battlefield conditions, and then you ended the letter by saying, we are moving towards violent times. Now, you know, Michael, I turn on CNBC and Bloomberg, and there isn't anything violent or anything we need to be worried about at all in America. Everything is under control with all those PhDs from Harvard, Princeton, and Yale in charge of our well-being. So what are you seeing that causes you, what are you seeing from your technical analysis? You know, we have a lot of people on here that talk from a fundamental point of view, but it's hard to measure that. You really do a lot of work on a technical basis that I think removes the emotions, removes the biases to a great extent. What are you seeing that causes you concern?
Well, by the violence, of course, I was referring to market violence. If you view assets as various categories, I know there's an overwhelming bias among investors to look at equities as the primary arena, which is an unjustified thing. I think it's over time, sophisticated investors have been taught the lesson repeatedly that there are other places to be. Hence, commodities have become a viable alternative over the last 20 years or so. There's the debt arena and there's the foreign exchange arena. Those four categories are all exchange traded, either via futures, via individual stocks, or via ETFs. So that world is totally open up to the investors, long or short, in four asset categories. So the world is not just equities. But when you look at the developed market indexes, Europe, FTSE, Japan, and us, omitting the emerging markets and omitting China, which is very violent this last year to the upside. Basically, what you see is a yawn. The S&P has gone sideways for 6 months, oscillated several percent above or below its September price high, which was 2019, and violently oscillated, but it's trendless, effectively. I think it's a topping process. In fact, I've declared it a top. Now, that doesn't mean the top tick has necessarily been seen. I've left open the possibility you might see something a few percent above last year's high, which was 2093, and right now we're in the high 2060s. But basically, when you stand back and look at the developed market equity indexes, the blue chip indexes of Europe and so forth, and here, it's a yawn. It looks steady. It looks copacetic. You know, it doesn't evoke violence. But when you look at the other three asset categories, it's been horrendous. We've had crash-like conditions in the debt area where, for example, the spread relationship between high-yield debt, risk-on debt, so-called, and low-yield or risk-off debt, namely Treasury-type debt, there has been a total collapse in the spread relationship between high-yield and, for example, TLT, the ETF of government 20-year debt, so forth, where it's been almost a 40% collapse in a matter of several quarters. That's horrendous. That's not minor. That's neon type sign type situation. And then at the same time, we have an oil collapse. Probably the core, the most weighty commodity out there, to collapse more than 50% in a matter of 6 months, with virtually no support on the way down. So there's a commodity asset category that's had a major collapse. And then we have the euro collapse from the 140 area down to 111 area very rapidly. And so you take the second largest reserve currency in the world and do that kind of thing to it. That's crash-like. That has repercussions and effects that not necessarily will come out immediately, but over a short period of time. So when you have that going on in three of the large asset categories, and you have this equity indexes yawning, you have to wonder whether they're going to be continuing to yawn. as the next quarter or two goes by? I strongly suspect not. I think they're headed down. My annual momentum work on the S&P argues to me fully that we are in a top. Do not be dissuaded by near-term action. It could be very deceitful. In fact, I think in that weekend report I showed the action in 1987, for example, which was quite similar, though briefer, than what we've been doing for the last several months. Namely, you make a high and you drop, and then you go into this confusing back-and-forth fistfight. Where it looks like every 2 weeks the longs are winning, the next 2 weeks the shorts are winning, but it really is going nowhere. That kind of deceptive action is not uncommon, and I do think it's deceptive, and I think the upside right now is deceptive, but I give it due respect, and there's a possibility, and I think that possibility is definable in the next 2 weeks. In other words, if the bulls want to take the S&P back to the high and make a new high, I think the door is open for them, but it's open about through the end of February. And beyond that, not. If they have not achieved that, then I don't think they're going to. And even if they have achieved it, I do not trust it. So basically I'm saying the extreme violence in the three major asset categories is important. It cannot be ignored. It can't be said that, oil's good for the economy and so forth, and you try to talk yourself into a positive view of these crashes. Remember in 29, the crash, the first 6 months off the August high of 29, the Dow lowest weekly close versus the highest weekly close was 39% off the high. Well, the three categories I just defined have equaled or matched, exceeded that.
Wow.
So we've had 29 type crashes in three asset categories. That should not be ignored. And I think that's the theme I was striking there.
Oh, that's remarkable, and I think you highlighted the last time we talked to you the rapidity with which these markets have crashed over such a short period of time. I mean, if you have a gradual over a couple of years instead of over a few weeks, you have some time to adjust. The markets have some time to adjust. It's almost as if the markets have hit an air pocket, and there's just no support, as you say, almost just without any support. Seems very anomalous. I mean, these are not usual markets, are they?
No, this is in 40 years I've seen two asset categories at once go. In 2008, for example, late in 2008, commodities went with stocks to the downside. But the foreign exchange markets weren't really, nothing was going on there. The debt markets were steady and so forth. So there wasn't the comparable events so widespread. And in 87, for example, it was strictly stocks. In 2000, 2002, it was stocks. Commodities were steady to up. So it was isolated. But now we have three of the four major ones collapsing in ways that, again, the speed is the issue, too, because it creates damage that people can't adjust for. I'm talking institutions. So the damage is far worse because of the speed. So I do not think the equities will survive it. I think that they can yawn and pretend, and it looks good on the tape and so forth and so on, but it ultimately will cave. That's my assessment.
Well, you also stated in your concluding remarks, you said there are now two essentials and only two to watch, and those are the S&P and gold. Why those two?
Well, gold, has not been that violent. We did make new lows in gold after it collapsed in 2013-14. It paid its dues a long time ago. And gold to the world economy is not so severe as oil is in terms of its ramifications. So gold paid its dues, built its base, and then made a low in November at 1140, which was a level that we thought would be the low. And on the way back up, MSA has advocated to investors who want to be in gold or gold-related platforms to build a position, not go fully 100% long, whatever they might otherwise wish to have, and wait for the final hurdle to be crossed. Well, that hurdle was touched, and I thought it would be resistance initially. It was a 1,300 level, and we've now backed up $70 from that level. Not too rapidly. It took 2 weeks to do it, so it wasn't like a sudden or dangerous. That pullback does not look malignant to me. It looks like it's setting structure. To define what I mean by that, if you see a price chart, for example, go to a given level a couple times, and then so you can draw a line across a set of highs, that's called structure building. And when you go through it, you can mark the spot. Well, in the case of gold, it's been doing it on my momentum work. And that 1,300 is a level now in momentum that if you return there one more time, most of my momentum indicators are going to really blow a hoolie, and the longer term ones. And that's the point where MSA will basically say 100%. bullish on gold. Right now, I'd call myself in the 70-75%. You should be long that much of whatever you want to have long, and and some of that was put on at a lot lower levels than this, by the way. Now, I watched gold because I do think it's inverse to the S&P now. There was a time period where that was not the case. So I think if gold breaks through that 1,300 in the coming months, I will bet the S&P is doing the opposite. And on the S&P, I think it's quite simple now. I think the long-term momentum has done its damage, has rendered its opinion about what the market is doing, and that is it's topping. Price usually lags momentum. In other words, via momentum indicators, if you know how to plot them and use them, you'll usually see your turn there first, and then some short time period later, maybe a few months even, you'll see price finally capitulate and join its momentum shadow, so to speak. I think you can basically take the price lows of the S&P for the last few months and believe them. If you break them, you're going down. And those lows have been probed into the 1990s, but never touched 1980 this year. Probed, I think, 3 times down into the 1980s without ever touching 1980. I think you can take the price chart at its face value. If you break it, you're really going down.
Sure.
Yeah. Go ahead.
Yeah, it's very interesting because you were saying that the price lags momentum, and I was just seeing this is from a fundamental point of view. I was seeing a chart yesterday. I don't know if it was on Zero Hedge or where it was, but they were showing collectively the analyst projections for earnings out for the next quarter, and there's a huge disconnect with where the price of the S&P is right now. So from a fundamental point of view, it seems like it's falling in place with what you're saying potentially. But I would like to ask you also, Michael, about the dollar, because the dollar used to be inverse to gold, and more recently we're seeing the dollar and gold. Well, the gold has backed off the last few trading sessions or so, but we've seen both of those currencies move higher against everything else in the last, since about mid-December. Any thoughts along those lines?
Yeah, I think that the correlation of the dollar to the gold is mistaken. I think if gold is a currency, which money is money, which I do believe it is. It's not merely a commodity. That in an effect, when you take the 2 reserve currencies of the world and drop one of them off the page with the potential to go a lot further, that's the euro. That kind of volatility, violence, and so forth is destabilizing. It indicates there's something wrong with the money units, the 2 major money units. They're not properly priced. There's some great mistake going on out there in these yardsticks that we call money. And therefore gold shines in that regard because it doesn't have that attribute. It has the staying power of value over history. And suddenly then you have people like Putin acquiring gold aggressively over the last 9 months. The Russians now are the 6th largest holder of gold. The Chinese are buying. You can't quite trace the quantities and so forth, but it's alleged that it's substantial.
Right.
And you have the Germans wanting to repatriate their gold from the Fed and from Paris. Somebody's doing something for a reason.
Yeah.
And
well, exactly right. And I was just quoting the finance minister of Greece here in my introductory remarks, and he's talking about how if you pull the Greek card away from the euro, it's the euro is a house of cards, and they're all going to come down. So, are you suggesting that the euro has a ways further to go down from your technical work?
Just even on a price basis, if you just get a price chart of the euro, go back to its history, 1990, whatever, you can see that what we just broke through over the last few months is a mammoth topping process, and in no manner has price or momentum reached levels that indicate satisfaction or a swing measured move to the downside having occurred. It looks like the breakout has just occurred. There's some mumbling around right now, and it wouldn't surprise me to see a minor rally or something, but I wouldn't bet on it on the euro. The yen is the one I'd bet on having a better rally at some point. But it does not look satisfied, and the fundamentals like you cite, I think the Greek card is the big card. And people who want to poo-poo it and say, well, it doesn't matter. Well, maybe Greece doesn't matter, but there's movements in Portugal, Spain, and Italy that are very sympathetic to this Greece movement, and they're gaining popularity. And it won't take investors very long to make the connection that, who's next?
Right. That's...
Yeah.
Well, anyway, the old saying that if you owe the bank $1,000, the bank has control, but if you owe them $1 billion, you have control. And I think, so these are very, very interesting times to say the least. Mike, we only have a couple of minutes left here. I want to ask you about something you wrote about in that same February 8th missive a gold ruble. And you picked up on an article that I also read from the Mises Institute on the possibility of Russia or the ruble being backed by gold. Could you comment on that just a little bit?
Well,
I know it's a fundamental point of view.
Yeah, I'm not an expert on these intricacies of, how much gold do they have in relation to their currency, but I understand the relationship's pretty good with the Russian ruble and the amount of gold they've got. But I suspect there's some substance to that. I think the academic article in Mises was quite good making its points. That wasn't an issue it's not just something that just came up. I noticed that Doug Casey, for example, back in a Reason TV interview, I think last summer, casually commented that he wouldn't be shocked in the next few years that with the yuan, the Chinese yuan, and the Russian ruble are gold backed. And now I think the evidence is mounting with the purchases that Putin has made over the last subsequent 9 months that something's going on in that regard. Now, whether he converts it to gold, I don't know. But you don't buy that much gold for nothing. And I think he wants to insulate the country's not a debtor nation by any standard.
Oh, that's exactly right.
And therefore his position in terms of state debt outstanding relative to GDP is minuscule compared to ours, or the Italians, or the French, or whatever. So he's actually in a better position in that regard, despite the low oil prices that are punishing him. To create a more stable ruble, despite the low oil prices, if you connect it to gold, that would tend to stabilize it.
Yeah, it's very interesting. Michael, the Soviet Union come down because of their statism, their enormous indebtedness, and their lack of ability to have a free market. Well, they didn't have a free market economy, and so they became so. Basically, it was a financial crisis, a financial demise. Essentially, they weren't defeated through a war or anything. And now Russia itself is in good shape financially. Interesting, isn't it, how we keep hearing in the Western media about how dire straits Russia's in, and yet they're importing huge amounts of gold. They're buying gold. So, and then the concerns in the Western press about Greece sort of moving towards Russia. In fact, the new Greek leader is suggesting that could be the case. If he's not treated well enough. So these are really fantastically interesting times. And I just would like to say to our listeners, it's Oliver MSA. Oliver, M as in Mary, S as in Sam, A as in Albert.com, OliverMSA.com. Go there. Michael writes about things. I mean, we didn't have time to talk about oil and natural gas, the risk-on, risk-off trade very much. Copper, he's had some ideas on lumber. Michael does tremendous work. I think momentum, structural stuff that really makes a lot of sense to me. I don't fully understand how he does it, but I've seen it work very well. And he mentioned a little while ago about China. Well, Michael was the only guy I know that was saying it's time to buy Chinese stocks. And boy, if you'd listened to that, you'd made a lot of money last year. So I think those of you who are serious investors might want to consider Michael's service. It's OliverMSA.com. Michael, I'm so glad you could be with us again. Lots more to talk to you about. I hope we can have you back on very soon again, possibly next week.
Look forward to it, Jay. Thank you very much.